Howdy, Jacob here. Today we're looking at Badger Meter in the electronic equipment, instruments, and components industry. 5.5 billion market cap and slightly lower enterprise value. They manufacture, market flow measurement, quality control, and communication solutions worldwide. Founded in 1905, been around for quite some time here, and they are still nearly doubling their revenue from 10 years ago. So that's very impressive to say the least. Increasing gross margin, increasing operating margin, increasing earnings per share, increasing return on invested capital, all great things. And return on invested capital in the mid teens, upper teens is very impressive. Return on assets still double digit, super awesome for them. Balance sheet shows 192 million cash on hand, zero short-term debt, zero long-term debt. You gotta love that. That's a balance sheet worth loving. Cash flow statement, pretty good production of free cash flow, low capital expenditures, good production of cash from operations. Use of cash, though, is not necessarily where I'd be wanting this to be. So, acquisitions and dividend. Dividend pays out about 40 to 50% of their 5 year average free cash flow. So, it's not so much that you'd be concerned with it, but their other use of cash is acquisitions. So, kind of the two forms of free cash flow that I think are the most man, especially with a debtless company. I mean, I want this company to be reinvesting at 10 to 15, 20% that they've gotten historically on their return on invested capital, and then buying back shares that are hopefully stupid cheap. But maybe it's not cheap. That's why they're not buying back shares. 53 PE with the highest operating margin it's ever been. I got a feeling this ain't going to be pretty when we go up to the valuation side of things. So, dividend, they can definitely afford it. Let's see. Let's do revenue first, though. So revenue growth with acquisitions, with inflation. I think that maybe 7% makes sense to me. I'd give it a premium, but they're not reinvesting. They're just making acquisitions and paying a dividend. So I'll just do a slight premium above the market. They can afford the dividend. Let's increase it with the revenue. Keep the payout roughly the same. For margins, what are we looking at for averages here? Okay, let's do 13, 15. I do like that free cash flow is quite a bit higher. Let's say they just offset stock-based compensation. That'd just be 10% of free cash flow, so really nothing there. Um, and WOOFTA, yeah, 78% drop to get to the price I'm looking for here. I mean, I'm not surprised. It's currently a 53 PE at one of the highest margins it's ever been. I just don't think their growth is going to be beyond your discount rate. And so I don't think that, um, I just don't think it's the best investment right now. I think it's a fantastic company. I mean, everything I saw looked fantastic except for valuation, but that's the most important part. Valuation is going to be, you can buy things at a somewhat expensive price. I don't know if you've heard Warren Buffett or Charlie Munger say you buy a great business at a good price, better than a, good business or whatever, at a decent business at a great, fantastic price. But it still needs to be at a good price. I mean, the assumptions you'd have to make for this to be a good return on your money, I mean, you'd have to really be confident in the business being there for 20 plus years. And really, you'd have to say the revenue growth is going to be roughly the same as your discount rate so that the 50, even if it contracts to a 25 PE, you'll have a decent return on your money. But I just don't see that being the case here. And again, I'm looking at a 7 year period. I just don't see how this company deserves that much of a premium. A 50p, I just don't think so. So I hope you enjoy the video. Have a great rest of your day. Thanks.